Welcome to the deep dive. Today we're really getting into the weeds on a huge name in media and entertainment, one that's going through some massive changes. Warner Bros. Discovery.
That's right. We've gone through their latest financial reports, the actual filings, to bring you the key stuff.
Yeah, our goal here is basically to give you a shortcut. We want you to understand the big strategic moves, the financial juggling, and really what it all points to for the future of entertainment.
Think of it like getting the real story behind the headlines.
You know, how a giant with brands like HBO, CNN, DC Comics, how they're trying to navigate this really fast-changing media world. We'll pull out the facts straight from... You almost can't avoid their brands. Discovery Channel, HBO, HBO Max, CNN, DC Studios, TNT Sports, Food Network, TLC. The list just goes on and on.
It really does. So this powerhouse deciding to, divide itself, that's the core story.
The plan is to create two more focused entities.
Right. The first one they're calling Warner Bros. That's going to hold the streaming and studios parts, so think Warner Bros. Television, the motion picture group, DC Studios, HBO itself, HBO Max, plus all those massive film and TV libraries, basically the big content engine.
And the second company, Discovery Global. That one takes the global linear networks segment. So your traditional TV brands, CNN, TNT Sports in the U.S., Discovery Channel, lots of free-to-air channels in Europe, plus digital stuff like Discovery Plus and Bleacher Report.
Okay, let's unpack this. A huge media conglomerate splitting up. What's the thinking here?
Well, the idea, officially, is focus, creating two companies that maybe appeal to different investors. One potentially high growth, the streaming and studio side, and the other maybe more of a stable cash flow generator with the linear networks.
But it's not a done deal, right? The timeline is mid-2026. But it depends on board approval, getting the right tax opinion, so it's tax-free market conditions.
Exactly. And what's fascinating here is how this separation aims to create these more focused entities. But it really raises the question, what are the challenges and potential benefits of such a massive strategic divorce?
Yeah.
The company's own report is cautious, saying there can be no assurance that the separation will occur, or at all.
So what happens if it doesn't go through? What are the risks there?
Oh, the risks are pretty significant. If the separation fails, you could see a pretty negative reaction from the stock market. But it's not...
Not at all. They might not get the benefits they hope for. They'll definitely have ongoing costs, maybe even dis-synergies, where things actually become less efficient apart. And, each new company is smaller, less diversified. It can't rely on the other half's cash flow for things like paying debt.
And they actually state that risk pretty bluntly in the report.
They do. They say there can be no assurance that the combined value of the shares of the two resulting companies will be equal to or greater than what
the value of our common stock would have been had the separation not occurred. It really highlights the gamble involved.
Wow. Okay, so to really get why they're taking this gamble, we need to look at the numbers. They're...
Okay, so first, streaming, just an incredible turnaround. Revenue up 8% over $5.4 billion. But the profitability, that's the headline. It went from losing $21 million in the first half of 2024 to making a profit of $632 million in 2025.
Wow, that is a massive swing. So streaming is actually making money now. And what about the studios, film and TV production?
Also very strong. Revenue up 16% or $6.1 billion, and their adjusted EBITDA,
basically a measure of operating profit, more than doubled. It went from around $400 million to over $1.1 billion.
So clearly streaming and studios are the growth engines, right?
And if we connect this to the bigger picture, this contrasting performance directly supports the whole rationale for separating the company. You can see the shift away from linear happening right there in the numbers. It basically lets them carve out the growing parts from the declining, though still cash-generating part.
It makes the why much clearer. But, none of these big moves, like splitting the company, would even be feasible if they hadn't gotten serious about their debt. And looking at the numbers, aggressive debt management feels like an understatement.
It really does. They cut their total debt by over $4.5 billion just in the first 6 months of 2025, down from nearly $39.5 billion to $35 billion. That's a huge reduction.
How do they manage that?
Well, a few key things. One really big move was in June, they did what's called a tender offer. Basically, they offered to buy back a whole bunch of their old bonds, about $17.7 billion worth, for less than they were originally worth.
Like getting a discount on paying back a loan?
Kind of, yeah. And because they paid less than the face value, it resulted in this accounting gain of about $3 billion. It instantly makes their balance sheet look healthier.
Okay, but how do they fund that buyback?
Well, they took out a large short-term bridge loan, $17 billion for 18 months. The interest rate is pretty high, over 7%. They state they intend to refinance this with permanent financing soon, but it comes with strings attached, restrictive covenants that limit what they can do financially while it's outstanding.
So a temporary fix, but a necessary one for that big debt reduction move. What else?
They've also just been steadily paying down other maturing debt. They paid off over $2 billion in notes due in March 2020. Exactly. And they also trimmed their main revolving credit line. Think of it like their corporate credit card limit from $6 billion down to $4 billion. And they increased their ability to borrow very short-term cash called commercial paper. Importantly, as of June 30th, they hadn't actually borrowed anything against either of those lines.
So they have access to cash if needed, but they're not relying on it day to day.
Right. And one more thing they're doing is managing cash flow through what are called receivables programs. Essentially, they're selling the right to collect money that's owed to them in the future, to get cash now.
Speeding up the cash coming in.
Precisely. They sold off about $100 million worth of receivables in the first half of 2025 this way. And they have a larger program that lets them do this with up to $5 billion worth. It's all about maximizing liquidity and flexibility, especially when you're paying down debt this fast and planning a massive corporate split.
It really shows they're pulling every lever possible to strengthen the balance sheet before this potential separation. Makes sense.
Definitely. It can make both new companies look more appealing to investors down the road.
Okay, that brings us to another really interesting piece of this puzzle. Strategic partnerships and the legal headaches that can come with them. Remember Venue Sports?
Oh yeah, the big sports streaming joint venture announced early 2024, WBD, Disney's ESPN, and Fox. It sounded like a potential game changer.
It did, but then almost immediately.
Just 2 weeks later, Fubo TV hits them with a major antitrust lawsuit, basically saying, hey, you three giants teaming up will kill competition in sports streaming.
And then it all just seemed to fizzle out. So what does this all mean for the big streaming wars? A joint venture announced, a lawsuit, a settlement, and then just poof, it's gone.
Well, first the settlement. The three big players, Disney, Fox, WBD, ended up paying Fubo $220 million collectively to make the lawsuit go away. WBD's piece of that was $55 million.
Okay, so they paid to settle, but then what happened to Venue?
Just days after the settlement, in January 2025, they announced they were discontinuing the whole Venue Sports joint venture entirely.
Wow. So the whole thing just collapsed.
It really raises an important question about the competitive landscape in streaming sports, doesn't it? It shows just how tricky these big collaborations can be, especially when regulators are watching closely for antitrust issues. A failed venture like this sends ripples, making other potential partners maybe a bit more hesitant.
Yeah, a very public, expensive lesson in the difficulties of teaming up in that space.
Definitely. It illustrates the complexities and risks when major content players try to pool
resources, particularly under that kind of legal scrutiny.
Okay, away from the drama of Venue, there was another little portfolio tweak mentioned. Something about the Discovery Family Channel and Hasbro.
let's touch on the regulatory side. Compliance, taxes, the less glamorous but crucial stuff.
Well, WBD is what's called a large accelerated filer. This means they're a very big public company, subject to stricter SEC reporting deadlines and internal control requirements.
And their top execs, the CEO and CFO, have to personally certify that those controls are working and reports are accurate.
Exactly. Which they did, as recently as August 7, 2025, according to this filing.
It's standard but important reassurance for investors.
Now, what about taxes, especially international ones? That always seems complicated for global companies.
It is. There's this big international agreement, the OECD's Pillar.
That's the idea. WBD mentioned they're implementing this. For the first half of 2025, they said the impact on their actual tax bill was immaterial, basically not significant yet. But long term, it's a major compliance effort and could definitely impact their overall tax rate depending on where they earn profits.
And there was a new U.S. tax law mentioned too.
Yeah, something called the One Big Beautiful Bill Act, signed on July 4th, 2025. The report just says they're still evaluating its potential impact.
So the takeaway is the tax landscape is constantly changing, adding another layer of complexity they have to manage.
Always something. Okay, let's pivot now to people and protection. How does WBD...
You get granted units that represent shares of the stock. The value goes up and down with the stock price, but you don't actually get the shares right away. You have to stay employed for a certain period to the WBD directors that look like typically 100% vest to start about a year, or at the next annual meeting in 2026, whichever comes first.
So it's the golden handcuffs. You stick around, you get the stock.
Pretty much. It aligns their interests with shareholders. If the stock does well, they do well. But importantly, until those RSUs fully vest and the shares are issued,
The holders aren't technically shareholders. They don't get dividends. They can't vote the shares.
It's a promise of future ownership, tied to performance and loyalty. What about taxes on these?
Okay, so as a key tool for keeping talent invested in the company's success, what stands out to you about how WBD handles its executive and employee incentives through these RSUs?
well, it's pretty standard for a company this size, heavily reliant on stock performance linkage and vesting periods to ensure retention. The linear cliff vesting is relatively common for directors. It's a core part of their compensation structure.
Makes sense. Now, about protecting all that debt, you mentioned debt guarantees. How crucial are those?
Oh, absolutely critical. Think about it. WBD is the parent company, but a lot of the actual borrowing might be done by its major subsidiaries, like Discovery Communications or Warner Media Holdings. Exactly. It's a joint and several guarantee, meaning lenders can go after any of the guarantors for the full amount. These guarantees are usually unsecured, meaning not tied to specific assets, but they carry the weight of the entire WBD enterprise. There are conditions for when a subsidiary might be released from the guarantee, but generally it provides significant comfort to lenders.
And you see all the big bank names involved as lenders and agents, Bank of America, JP Morgan, Goldman Sachs, Barclays, PNC. It really shows the scale of the financial structure needed here.
It does. These guarantees are fundamental to maintaining access to the capital markets and ensuring financial stability across the whole group.
So when you pull it all together, what we've really unpacked today is Warner Bros. Discovery in the middle of this incredibly complex, multi-pronged transformation.
Yeah, they're hitting it from all angles, aggressively managing debt, that huge strategic rethink with the potential company split, navigating all these legal things like VNU, tax changes.
And it all seems geared towards one thing, trying to optimize their financial health and really carved out a path for future growth in what everyone agrees is a super turbulent media industry.
It's genuinely a pivotal moment,
Yeah.
not just for WBD itself, but you could see it as a kind of case study for the whole media sector, right?
Yeah.
So maybe the thing to leave people thinking about is this.
Mm.
All these bold moves, splitting the core businesses, slashing debt, dealing with the V&E fallout, is this kind of aggressive financial engineering the key to letting those iconic content brands, HBO, Warner Bros. Movies, DC, actually thrive in the digital age?
Cool.
Or does it maybe signal just how incredibly difficult it's becoming to maintain any kind of traditional media empire when digital disruption is just relentless?
That's a deep question. What does it mean for how we actually consume entertainment, and ultimately who gets to control the stories we all watch?
Exactly. Lots to mull over there.